This conference will now be recorded.
I need a reminder to tell me to record these sessions.
Oh, your
If I'm
computer
not,
is so fancy.
say what?
Your computer is so fancy. It lets you know when you're recording. I must be poor.
That is the program that we're using. So it's not so much the computer, but it's the program. And so now you know that you're recording and uh, you're being YouTube for the rest of your life. So when you're presenting and everything, you got to be need to be dressed up, looking good, right? Because you'll be on television. Okay. So in accounting, there are four financial statements that we learn how to prepare. So this is the purpose of accounting, and you're going to learn how to do this by midterm to prepare an income statement, which is the revenues and expenses for a business, a statement of retained earnings, a balance sheet. Statement of retained earnings just shows how much of the income you kept in the business. A balance sheet reflects the assets, liabilities, and stockholders' equity. So you have a balance sheet now. You have some assets, some liabilities, and if your assets exceed your liabilities, you have some equity. And so with a company, we prepare those statements. We wait until about the third cycle, third part of the course to do the statement of cash flow. But these are the four statements that you have to be able to prepare. You will be tested on them at final exam time. Who uses financial statements? Uh, Internal people use them. You're an employee, you work for somebody. You might need to know, you plan to work for somebody, you might want to check their financial statements to see how they're doing. But investors, creditors, suppliers, tax authorities, regulatory authorities, everybody use the statements of the company because they reflect what's happening. And I discuss here, shareholders, when you go invest in a company, or if you invest in a company, you need the statements to see how it's doing. Investors, if you're going to invest in a company, bankers, if they're going to loan money to a company. Okay. Then we get to generally accepted accounting principles and where they come from. Securities and Exchange Commission is the organization created by the government to regulate the preparation of financial statements. You can't just do anything. And so, once we had the Great Depression, they said, well, we need some rules in terms of how the financial statements are prepared. And so the Securities and Exchange Commission was tasked with that. The Financial Accounting Standards Board does most of the work because they've got the practitioners and the professors in this group working on. So they do that, with authority from the Securities and Exchange Commission. Then governmental agencies, Texas Southern, City of Houston, State of Texas, they've got their rules because, governmental agencies go bankrupt. So we got statements from them. And then we have the International Accounting Standards Board, where everything is international now. And so we have to have universal standards because you may be investing in an international company. So we have to make sure all the statements are uniform. And so those are the organizations or entities charged with creating the financial statements. And there are 15 generally accepted accounting principles that you will eventually have to know, not doing the first testing, but eventually. The business as a single entity, when you create a business, is separate from you. Most times we're going to have a corporation to limit liability. But there's the sole proprietor, the small business, the partnership, and these would be small business doing things together. To limit liabilities in these cases, we have limited liability companies, then we have the C corporation. This is the big corporation, that can raise money. Then there's a subchapter S corporation, still a corporation which gives certain corporate advantages, but you don't have the double taxation. We have the specific currency principle. We use dollars. Specific time period principle. We typically base everything on a year or a quarter. Historical cost principles. We use costs when we record items. Full disclosure principle. If there's something that has occurred that's going to impact the financial statements, then we have to put that in. So if the virus is impacting the company, even if the 2019 statements looked okay, we got to say, okay, when we issue those statements in 2020, when they were issued, there would need to be, okay, the virus is going to impact it this way. At the end of 20 and 21, you have to indicate how the virus is going to impact the company. The recognition principle, income is recognized when received. The going concern concept, we think the business is planning on continuing operation. Matching, we match revenues and expenses. Principle of materiality, we weren't trying to be perfect, and so if something is minor, we will ignore it. Principle of conservatism, we're going to be conservative and not be guessing about what's going to happen. The industry practices constraint. Sometimes industries have special rules, such as the energy industry here in Houston. Consistency, we're going to do the same thing the same way all the time. Objectivity, we're going to be objective. We're going to use accrual basis accounting, which basically says that we look at things when they happen, not when the cash is received, but then we still have to assess the cash that the company has to make sure it's not going to go bankrupt. So those are 15 statements. We'll come back and talk about them again at the midterm period, and you'll be tested on them now. Just want you overall familiar with them. As a chart of accounts for businesses, which consists of the assets, the liabilities, the owner's equity, income, and expenses and dividends. So this is kind of a referencing. If you see something listed and you don't know what it is, if it's an asset, you can come back here and look at, okay, what is the asset? Cash. Account receivable. If you do the work for somebody and they owe you money, there's an account receivable. That's a good thing. Inventory, prepaid insurance, supplies, land, equipment. So a lot of these things, but as you come across these in chapter 2, you can come back and refer to these. Then we have liabilities, accounts payable. Accounts payable is like your credit card. You buy something, you pay it later. So we list the various types of liabilities. Then stockholders' equity. When we have a corporation issues common stock. And the common stock is at a set price. If you pay more than the listed price, it becomes additional paid in capital. We'll talk about that later. Treasury stock, when you buy your stock back. Retained earnings, that's the earnings that are retained in the company. Dividends are distributions paid to the shareholders. Shareholders are paid dividends. Income summary, temporary account. Then we have revenues and expenses. So a business will have all of these types of accounts. This chapter just discussed parts of that. And by
I have a question.
Yes.
About the examples for operating income and like expenses and stuff like that. So for the example that you gave us with the balance sheet just now, it shows interest expense as your operating expenses. But then when I was looking at another example, it was listing interest expense as a non-operating uh non-operating income or non-operating expense. Is that like the same thing?
Okay. Sometimes, when we look at interest expense, uh, if I'm running a business and I'm paying rent, utilities, salaries, those are my regular operating expenses. If I borrow money to pay some of those expenses and I pay interest, it's kind of not operating. It's an extra thing I got to pay. So sometimes we want to separate that out to see, what are the regular operating expenses such as salaries, advertising, and then sometimes we say, well, the interest expense, we're going to say that's a financing expense. It's a little separate. And we keep track of that separate. But that's a good question, and we'll talk about that later.
Okay,
But it
thank you.
kind of doesn't matter in terms of how we're going to work with it. So by midterm, you're going to be able to prepare an income statement. Revenue, less expenses, income. You're going to be able to prepare a statement of retained earnings. What are the earnings? What's the income? What are the dividends we paid out? How many we have? And you're going to be able to prepare a balance sheet where you list assets, liabilities, stockholders' equity, and the statement of cash flow. We wait till about the third exam period to work with that. Here, your multiple choice questions that you need to work on these probably after midterm, I'm gonna think, but around that period, I'll let you know. But this is just a reference chapter for you for now. It's just a reference chapter that gives that theoretical framework. We're gonna do some practical things for a while, and then we will come back to the theoretical framework. The accounting cycle. And to learn accounting, you got to move from how you normally think about things, to looking at, I need to be able to run a business from my house possibly and make some money. Okay. So you got to change your mindset. And if you were to start a business, you'd have a business plan and enough money, and you want to be profitable. So how do you start a corporation? You select a corporate name. You file your articles of incorporation with the state. You create an organizational chart. You obtain an ID number. You maintain corporate minutes. You issue shares of stock. There's a little simple stock certificate. And then you create an accounting system so you can do this. You can prepare these financial statements. Okay? So for each team, as we work through, I want each team to create a corporate name. So I want you to do number one. Then I want you to file some articles of incorporation. So look that up for your team and create that. Then I want you to issue some stock. So make everybody pay $100 or something, whatever you want it to be. And then you issue them stock certificates. So you're going through the process now of creating your business. We changing that mindset. So when you're presenting your homework to me over this first period, You have a company name, and so each team is responsible for doing that. It's not a major thing, but I'm just trying to change the mindset of how you need to think. Okay, the first thing we work with in accounting is an equation. Assets equal liabilities plus stockholders' equity. So that is the accounting equation. Stockholders' equity equals common stock plus retained earnings. Retained earnings is the revenues minus expenses minus the dividends that you paid out. So it's kind of a balancing thing here in terms of how we operate. So this equation is the fundamental thing that we work with. Everything revolves around this equation in accounting. Assets equal liabilities plus stockholders' equity plus common stock plus retained earnings. Okay. And so the first thing we do, and you got to do in a business, is put some cash in. So that's the first thing you've got to do. And so therefore, in our example here, we put in $100,000 in cash. And so that's our equity. So that's how that balance. Our money goes to the company, but we have back as common stock. So we don't have that money anymore. It's separate. The purpose of a business, of everything you're doing, is to increase cash and increase the earnings that you have. So that's why you start a business. You want more cash. You might have some other assets and you may get some liabilities. But at the end of the day, when you try to analyze a company, did the cash increase? And did the the earnings increase? Okay. So this is what you start with. You want more at the end. So you just kind of keep that in the back of your mind.
Can I ask you something?
Sure.
Regarding to this equation, it says cash and it says like common stocks. You said if we increase the cash, the retained earnings gonna go up. So what about the common stocks? Like, is it through the company, or because I'm new to this, so it's kind of like confusing to
You
me.
start a company and you put your cash in the company. Well, you put your cash in the company and you want that company to operate that cash to make money. So the common stock stays the same. That represents your investment. If retained earnings is going up, your company is doing well. If retained earnings is going down, then your company is not doing so well. Got it?
Yes.
Different way of looking at it. You put 100,000 in. Two things have to occur. Cash has to go up and earnings have to go up. So, let's look at an example, ladies. Suppose there were 3 eligible bachelors. There are 3 eligible bachelors, and they each have $100,000. So there are 3 eligible bachelors. They have $100,000. Bachelor A has $100,000 because he worked and he saved his money. Bachelor B has $100,000 because he got a lot of student loans. And he just went through the system, but he has $100,000. And Bachelor C has $100,000 because he engaged in the illegal drug business. So he has $100,000. Which one of those persons y'all gonna marry, ladies?
The first one.
The first one.
The first one.
They
The
all got
last
a
one,
hundred.
Yeah, he's the worst if he's for the
They all
last
got
one.
100,000.
Right,
but
but
the
if he's in
last one,
student
he
loans, you gotta pay that back. If he has student loans, $100,000 in student loans, that's not really feasible because you gotta pay them back. And then
exactly.
the last one is illegal, so I don't want to be in no tied up in no business. I ain't going to jail. And then the first one, it shows that he has like proper character building.
So he saved his money, and that just seems like the best option because he
Yeah,
don't got to
he's a
pay it
Okay,
back.
so
he's a
when
druggie.
you go work for a company, the same thing is happening. You marrying the company. And so you got to look at that company and see if it has cash and where did it come from? Did it come from earnings? Or does the company have too much debt? Same principle. But we're looking at it from a different way. And then some companies do engage in illegal activities. And so when you get ready to work for a company, you got to make those determinations. So that's why accounting is so important. I don't care what your major is. As people continually out there saying, come work for me now. You can work at home and make a whole lot of money. How do you know whether you should work for that company or not? You got to look at their financial statements. Okay. A long time ago in the 1400s, there was a guy named Italian Luca Pacioli, and he came up with the double entry accounting system. And what he said was that when two business people engage in a transaction, if you receive something of value, that was a debit, but you had to give up something of value, that's a credit. And if you think of your transactions now, that happens. You don't record it that way, but whenever you engage with someone, two things happen. You get something, that's a debit, and you give up something. It might be cash, it might be you charge your credit card, but you give up something. So when we're running a business, we create what's called T accounts. And for everything we buy, remember those assets we're talking about? If whatever we buy, we put it on the left side. Then what we gave up, we put it on the right side. So there's always two accounts. So if we bought some equipment, that's on the left side. We paid cash, it's on the right side. We gave up cash. If we use our credit card, we use that account. So there's an account for everything. And I showed it to you in that last chapter. There's an account for everything that's going on. And you have to see what account is involved. And did the account go up or did it go down? Account on the asset side. So we'll be looking at this concept as we go through learning double entry accounting. And returning to our equation, assets equal liabilities plus common stock plus retained earnings plus revenues minus dividends and expenses. So if we have debits on this side of the equation, and that's a good thing, then credits on the other side, and the credits over here are good things. Debits on this side are not good. Debits are good on this side. So that's just an accounting equation that you kind of need to begin, look at the accounting equation, look at, that we're going to put things on two sides rather than all over the place. And one side, the account increases. On the other side, the account decreases. So let's look at why we use T accounts. Suppose you had these transactions in your cash account, 50, 10, 15, 3, 15, 4, blah, blah, blah. How much cash you got? If you had this set up for cash, How much cash do you have? How much cash y'all got? If you add 50 plus 10, no, minus 10, minus 15, minus 3, plus 15, minus 4, minus 2, plus 2, minus 8. How much cash do you have? Is there any A student know how much cash they got?
Let me calculate that real fast.
Yeah, calculate that real fast for me.
I think you in a negative. I think you got a negative balance right now.
Somebody say you got a negative balance.
$25,000.
Anybody else? What?
25,000.
25,000 what?
I mean, is he right though, or
Deja, you supposed to be telling me.
look? I'm not the only one in the class right now. I can't, I can't hold everybody weight.
But I was practicing on saying your name right.
Thank you though. Thank you.
Okay. Now, let's see what we're going to do. Pacioli said, let's create a T account. When there's an increase, we had a 50 and what else? A 15 and a 2. We're going to put that on one side. Those are the increases, 67. Somebody did say 25. Then for the decreases, we're going to put all of them on one side. We're going to add up the increases. We're going to add up the decreases. Then we're going to subtract the two and get a balance. That's what we do, and that's what he worked with. Because you could have 1,000 transactions. You could be using Excel. But if you start putting pluses and minuses in, Excel will mess up sometimes. But Excel, if you put the pluses on one side and the decreases on the other side, and if you add the pluses and the decreases and take the difference, Excel will work just fine. So that's why we use Excel. That's the main reason for Excel. It adds and subtracts for us. It can add up things, then take that difference and get the balance. Any questions? So you'll be doing this all the time. So double entry accounting that we're working with is going to reflect the fact that all transactions have two parts. You're receiving something of value and you're giving something of value. So let's assume we bought an auto and we paid cash. You received an auto, that's the debit, that's what you got of value. You paid cash. You gave up cash, so we would credit cash. So what we got of value, we debited. What we gave up, we credited. That's that double entry system. Debit what we received, credit what we paid out. Suppose you borrowed money to buy the auto. You still got the auto, you debited, but now you're going to credit notes payable another account. You got something of value. You gave up something of value, your credit that you got to pay back. And then sometime we'll buy something and we'll pay some cash and then we'll take a note for the balance. You still got an auto, a debit, but you got to credit the cash for $2,000 and a credit the notes payable for $8,000. That fundamentally is accounting. And that's fundamentally what you'll be doing with your first homework assignment as we move to it. Okay? But we work with journal entries. Okay, let's see where we are. The accounting cycle. You can see 9 steps that you're going to learn how to do. Analyze transactions, make journal entries, post to the ledger, prepare trial balance, make adjusting entries, adjust the trial balance, and then prepare the financial statements. Number 7, close the accounts, post-closing trial balance. You're going to learn how to do all of that. but it's a step-by-step process. And we only working with step 1 and 2 for the first 2 weeks. Okay, just steps 1 and 2. So you don't have to worry about all these other steps yet. All we're gonna do is work with steps 1 and 2. And since these other steps follow, especially step 2, making journal entries, you can't do these steps unless you can do step 2. Step 1, analyze transaction. Step 2, make a journal entry. So we're gonna spend 2 weeks on journal entries, and I'm gonna do them today in next class period. Then your team is gonna be doing it class period 3. It's part of homework. Okay, so we only work with steps 1 and 2. So you don't have to worry about these other steps yet. We're just analyzing transactions and making journal entries. So let's get ready to make journal entries. Every financial transaction a company has got to be recorded. Each journal entry requires an equal debit or credit. Then we're going to read the transaction, determine what type of journal entry it is, and we're going to look at the impact on accounts. If you have an asset, if it goes up, you debit it. If it goes down, you credit it. At the end of the day, you want a debit balance. But right now, when an asset goes up, you debit it. If it goes down, you credit it. I'm going to skip contra assets for now. For a liability, when it goes up, you credit it because it's on the other side of that equation. When it goes down, you debit it. Normal balance needs to be a credit. Common stock, when it goes up, you credit it. If it were to go down, you would debit it. Retained earnings, when it goes up, you credit it. When it goes down, you debit it. You want the company to have a credit balance and retained earnings. That means it's doing well. If it has a debit balance, that's a problem. In this course, when we're dealing with revenues, for the most part, we're just going to have credits. For expenses, we're just going to have debits. So whenever an expense shows up in a transaction, we're just going to debit it. So this is a little chart you want to keep in mind in terms of when the account goes up, do I debit it? If it's an asset, yes. If it goes down, you credit it. And we'll be looking at it. So you just refer back to this chart eventually. Okay. And so one of the changes I made was to lay out the transactions that we're going to deal with in this course. And there are 20 types of journal entries that we deal with. But for right now, you only gonna have to deal with these first 3 here, BOLOs. Then we're gonna deal with number 5. I'm gonna bold it. Then we're gonna deal with these 4. Gonna bold these. Then we're gonna do that to me. I'm gonna bold this one. Then I'm gonna bold 15. Okay. So these are the only transactions that we're working with this first 2 weeks. Okay. So you don't have to worry about all of them, just the ones I have in bold. The first 6 transactions, the first 5 we're working with, reflect the fact that cash came into the business, and so we would debit cash and we would credit something else. If we issued common stock, we credit common stock. We had cash revenue, debit cash, and credit revenue. So this chart is telling you what to do to make a journal entry. If you collected cash on a receivable, you debit cash and credit unearned. You debit cash, credit account receivable. Then if you borrow money, you debit cash and credit note payable. So whenever cash comes into the business, you got something of value, you debit it, then this tells you the account that you're going to credit when you make the journal entry. Now, if you're making a journal entry and you paid cash out, cash is credited. Okay? If you bought an asset, you have to determine what asset it is, you debit it. If you paid a liability, you debit it. If you paid an expense, you debit it. If you paid a dividend, you debit it. But whenever you have transactions 7 through 10 where cash is involved, cash is credited. Then we have transaction 12, where we have a transaction where you bought an asset, but you didn't pay cash, you used your credit card. So the liability created is credited. And then if we had a sale on account, where we did the work, but we didn't get cash, we debit account receivable. And we typically just use the word sales, but sales, revenue, fees, they're all the same. Those are all the journal entries you got to work with, you got to worry about. Okay? Don't have to worry about any of the others. This is that chart of account that we talk about. So that whenever you use accounts in your journal entries, they have to come off this chart of accounts. So you don't create any new accounts. You know, the company, I got the accounts already created with the account number. So you don't be creative when you get ready to make a journal entry. You come to this chart of accounts. How are we doing time-wise? Nobody said anything, so I guess we okay. I've got 10 journal entries here to illustrate those 10 types that I highlighted. So I got an example of every one showing you how to make a journal entry. So there should be no reason why you can't make a journal entry. Let's go to transaction 1. I invested $10,000 into the business. I'm going to go up here and look at my types. And I'm going
Dr.
to
Boyd,
say,
not to cut you off, but you have like 20 minutes left because you asked about the time. So I just had to go back to my schedule to make sure.
thank you, because it's harder for me to keep track of it with the new system. I'll get used to, though. Thank you. So that type is a type 1, where it tells us we debit cash and credit common stock. That's when you form your company. That's the first entry we make. And if we were in the physical classroom, I'd have a yardstick. And if I ask you to make this journal entry, you got it wrong, I hit you on the head. Because that's the first one we cover. Debit cash and credit common stock. So I'm gonna have to figure out a way to hit some of y'all on the head if y'all missed this first one. Okay. So I want to make this journal entry. And what I'm gonna come in here and do, let me see, did I get rid of? Let me undo that a little bit. Let me undo a few of them, see if it'll let me undo them. Okay. Because what I want to go through it is all the way through, not just show something to you. because eventually you got to be able to do this. And I want to make sure you learn it all. Okay, so let's go back to this first transaction. So we're talking about transaction one. We invested $10,000 in the business, so the business gets $10,000 and it gives up $10,000. Okay, so the first thing I'm gonna do is determine the transaction type, and that's transaction type 1. Okay, because I kind of got them in order. So when you make a journal entry, you're gonna come over here and put, I'm working with 1, transaction 1. Transaction 1 says I debit cash. So I'm gonna go to cash. That's account number 100. So I'm gonna put 100 here. I'm gonna put cash here. And I'm gonna put a debit here, $10,000. Then I know I issued common stock, so I'm gonna go to common stock. That's account 400. So I'm gonna put account 400 here. I'm gonna put common stock here. Let's see, wait, see the common stock here. And I'm gonna put 10,000 here. That's what a journal entry looks like. That's the first one. Any questions on what I did? Okay. This is how you learn accounting. If you can't do this, you can't learn accounting. And I'll teach my Principles 2 class this afternoon, and there are going to be some people in there who can't do this. So how did they learn accounting? Okay, let's go to transaction 2. I receive income. So that's why I'm in business, to receive income. And I got $50,000. So that's the second transaction. I'm going to go up here and say this is a type 2. I got cash revenue. And I'm going to debit a cash account and credit revenue. Do we see that? That's the type it is, cash. Debit cash and credit revenue. So I already know cash is 100. Revenue of sales is 500. So this $50,000, I'm gonna put 2 here. I'm gonna put 100 here again. I'm gonna debit cash for $50,000. Then we said revenue was account number what?
I think you said 500. I think.
And this is a type 2.
Question, sir. Do we have to put sales all the time for that, or do we do like in the account and put like rental revenue, or like is it just all, are they the same thing?
Same thing, it doesn't matter.
Okay.
It's gonna come the same way. So you can put car own revenue there also. So, you know, if it's an auto business, it'd be auto sales. If it was jewelry sales, because you're gonna say what type it is. So look at what we did. We analyzed the transaction. We saw what type it was. So Deja, we about ready to do number 3.
on now.
Collection of cash from corporate customers, 20,000. We're gonna go up here. I got them in order for you right now. They're gonna always be in order. Collection of cash from corporate customers. That's collection on account receivable. Cash is still coming in. We're gonna debit cash, and we're gonna credit account receivable. Because we had, we got some cash. People owed us money. We have to give that up. They no longer owe us. So that's a good thing. They no longer owe us, but we have the cash. I gotta pick two accounts. I know it's cash 100, account receivable 110. Okay. So I got $20,000. So now we're at transaction 3. Debit cash again, 100. See how easy this is?
I thought it was 110.
Nah, he said for cash it was 100, but
But the account receivable
it's 110.
is 110. So every time we record a transaction, we got to make a journal entry. Every time any business has a transaction, it makes a journal entry. Okay? That's the first thing. Every time a Walmart makes a sale, it makes a journal entry. If it's a cash sale, it's going to the cash register. This journal entry is being made. And so that's what we're focusing on, just making journal entries. Number 4, we received a short-term working capital loan. So we borrowed some money. They go back up here. That's transaction type what? 5. We're going to debit cash and credit notes payable. And it's going to be a short-term note since we are dealing with working capital loans. So cash again. Short-term note payable. So I'm at 306 short-term note payable. So I'm gonna get up here and debit cash. And then I'm gonna go back up here and credit short-term note payable. Look at that, look at how it just jumps in there. And how much money did we get? 25,000.
Okay.
This was a type what?
4.
5.
Wait, no, it was 5. You right. My fault.
And this is transaction number 4. Okay. So in the first 4, cash came in. We debited cash every time. Now in the next 5, I guess 1, 2, 3, well 4. That's 4. 1, 2, 3, 4. We pay out cash. So every time we're going to credit cash because we're paying cash out now. So we're ready for transaction 5. So what happened in 5? We purchased supplies paying $1,000 in cash. So we go up here and we look. That's going to be type 7, purchase an asset. We have to put the asset we purchased down in credit cash. So what asset did we purchase? Supplies. How much supply did we purchase here? $1,000.
Yeah.
Then we're going to do something different with cash this time. It's going to be on that second line. So we're going to copy. All right, cash, do that. See how y'all going to be able to zip through these exams? And my credit column, I'll put the 1,000 here. And what type was this?
You said type 7, I think.
Yeah, type
Did I fix
7 for supplies.
that purchase of an asset type 7? Okay. So now you see what your team has to do?
Yes.
Yes, sir.
Kind of, sort of. I get it. I guess, I think.
Paid on accounts payable, 5,000. You're getting something that a lot of people just have trouble doing this. So you can't learn accounting. Because you can't do the first thing. Okay, that's payment of a liability. We're going to debit what? The liability paid and credit what? Cash. So we said we paid on accounts payable. So we'll go to this chart of accounts. Get accounts payable. I'm going to copy it. And let's get the line I put it right here. This is transaction, what, 7? And it's 6 paid on accounts payable. That's number 6. And how much did we pay on that account payable? 5,000.
Yes, 5,000.
We're gonna go back up here and get cash again since that's what we paid. And we said this is type what? 8. Now with transaction 7.
I have a confusion with this one, like why it's a type 8, like type 8 is payment of liability.
An account payable is like your credit card. If you buy something on credit, you pay you charge it to your card at the end of the month. What do they want? They want you to pay it.
Dr. Boyd, not to interrupt, but it's 12:50, so I was just letting you know on the time frame.
How we doing time wise? Good.
It's 12:50.
Okay, so it's 12:50. You all ought to finish this next time. So we're gonna go back and review this next time on Tuesday. So you still got a free day on Tuesday. Then on Thursday, teams 1 and 2 will be up for the journal entry study problem, which is already in course content. And you know by your number in the classroom which one of those journal entries is yours already. You already know. Okay? So we will pick up there next time. I will add the email addresses so you can see where your students are, your team members are. Tell them if they don't show up and do what they need to be, you're going to drop them off the team and drop them out the course, and we'll go from there. We're virtual, but it's the same thing, and so you got to treat it the same way. If you're working, you can't not be on the screen, and so this is kind of the same way. So we're going to have to educate people about this. It's not a free day because we're not in the classroom. We're taking roll and everything. But hopefully, we had a good first day. And